I want to talk to you about something truly unsettling, a warning that, for me, cuts to the very heart of financial security for every person in the United Kingdom. It came from within the Bank of England itself, an institution we typically rely on for stability. The message, delivered in late 2025, painted a stark picture of increased risks to financial stability that could lead to reduced access to finance for households. This isn't just about abstract economics, it's about your money, your future, and the bedrock of your financial life. What I find so compelling and frankly alarming about this warning is its source. When someone with deep, intimate knowledge of our financial system speaks with such gravity, you listen. They aren't speculating from the sidelines, they are seeing the intricate gears of the economy from the inside, understanding where the pressure points are, and identifying the cracks that could widen into chasms. Their perspective carries an immense weight born from access to data and insights that the public rarely sees. We are on a mission to reach 10,000 subscribers to build a community that is aware of these financial shifts. If that resonates with you, hit subscribe. Let me take you back to December of 2025. The Bank of England released a report that many, myself included, saw as a profound call to attention. It highlighted substantial risks lurking in what's known as the shadow banking sector. Now, you might be wondering what shadow banking even means. It's a term for financial activities conducted outside the traditional regulated banking system. Think of private equity, private credit, certain insurance operations, and those often mysterious hedge funds. This sector, I discovered, has expanded massively since the global financial crisis of 2008. It grew largely unchecked, fueled by the very regulations imposed on traditional banks after that crisis. What I find particularly concerning is that this sprawling, powerful segment of our financial world has never truly faced a macroeconomic downturn on the potential scale that we are now looking at for the year 2026. It's an untested giant, and its stability is far from guaranteed. The bank's report didn't just point to abstract risks, it highlighted vulnerabilities in the United Kingdom's gilt markets from leveraged hedge fund positions. These are government bonds, often seen as safe investments, but hedge funds use them for short-term, high-risk profits. The danger, as the bank warned, is that these massive bets are incredibly vulnerable to sudden meltdowns, perhaps triggered by something as modern and unpredictable as AI-driven share crashes. Imagine a complex, highly automated system designed for efficiency, suddenly encountering an unexpected variable. This is where I see a striking cross-domain connection. Think of it like a high-frequency trading algorithm. These algorithms are programmed to execute trades at lightning speed, often reacting to tiny market fluctuations. They can generate immense profits, but if a sudden unforeseen event, a black swan in market terms, triggers a cascade of automated sell orders, the entire system can spiral out of control in milliseconds. This is precisely the kind of systemic fragility the Bank of England was highlighting in the gilt markets. £100 billion isn't just a number. It represents a colossal amount of capital that, if suddenly withdrawn or lost, could send shockwaves through our entire financial system. For you and me, that means a direct threat to the stability of our pensions, our investments, and even the availability of credit for everyday needs. Just days after that stark warning, on December 18th, 2025, the Bank of England made a significant move. They cut interest rates by 25 basis points, bringing the base rate down to 3.75%. This was the lowest rate in nearly 3 years, and it signalled that further cuts were likely upcoming in 2026. On the surface, this might sound like good news, a welcome relief from the high borrowing costs we had grown accustomed to. But I want you to consider the context. This rate cut wasn't a sign of robust economic health. It was a response to a sluggish economy and rising unemployment. Inflation, while falling, still stood at 3.2% in the year to November 2025, according to the Office for National Statistics. While this was an undershoot of expectations and a drop from the previous month's 3.6%, it still remained stubbornly above the bank's 2% target. So, here's the paradox I see. The bank is cutting rates to stimulate a weak economy, but simultaneously warning of profound financial instability that could be triggered by the very forces they are trying to manage. It's a delicate balancing act, a tightrope walk between recession and financial collapse. For ordinary households, this creates an environment of profound uncertainty where the economic signals are mixed and the future feels increasingly precarious. The core of the warning, I believe, is this. If the shadow banking sector faces a major downturn, it could trigger a wider bank panic. Such a panic could lead to what are called fire sales of assets, where institutions are forced to sell off investments quickly, driving prices down further and exacerbating the crisis. And critically, for you and me, this would mean significantly reduced access to finance for households and businesses, amplifying the pain during any economic contraction. That, to me, is the practical definition of a savings freeze. Let me tell you why this shadow banking threat isn't just a theoretical concern. It's a deeply unsettling echo of the past, with new, dangerous dimensions. You might remember the global financial crisis of 2008. That catastrophe exposed a fundamental flaw. Credit rating agencies, the very entities meant to assess risk, had failed completely. They labelled vast amounts of bank debt as high quality that in reality proved utterly worthless. This lack of transparency and accountability nearly brought the entire global system to its knees. What I find so chilling is that the Bank of England is now flagging a similar dynamic, repeating itself in the non-bank sectors. We are seeing a parallel where the complexity and opacity of shadow banking operations make it incredibly difficult to accurately assess their risks. It's like a biological system, an ecosystem, where a new, rapidly growing species is introduced. At first, it seems benign, perhaps even beneficial, but its unchecked proliferation slowly starves out the native species and destabilises the entire environment, often with catastrophic consequences that are only apparent when it's too late. This massive expansion of shadow banking since 2008 has occurred without the rigorous stress testing that traditional banks now undergo. They operate in a regulatory grey area, allowing them to take on risks that would be prohibited for established financial institutions. It's a classic case of regulatory arbitrage, where capital flows to the path of least resistance and often least oversight. This is why the £100 billion gambled in United Kingdom gilt markets is such a red flag for me. It's a concentrated risk in an opaque part of the system. Consider this. During the 2008 crisis, the problem was largely contained within the banking sector, albeit with global ramifications. Now, the Bank of England is warning that issues in shadow banking could spill over, triggering panic in the wider financial system. This isn't just about big institutions losing money. It's about the knock-on effect on the real economy, on families like yours and mine. When finance dries up, businesses can't get loans, jobs are lost, and households struggle to meet their obligations. I believe the most direct and painful consequence for you could come through a stressed mortgage market or increased rental pressures. If a systemic crisis were to hit, the availability of new mortgages could plummet, and existing homeowners might face refinancing difficulties. For renters, landlords facing their own financial strains could pass on costs or even be forced to sell, creating massive disruption in housing. The bank's analysis explicitly mentioned that United Kingdom gilts and other assets are becoming increasingly uninsurable due to these rising risks, blocking lending and even making home moves difficult. This brings me to another cross-domain connection, one that speaks to human psychology. Think of the scarcity mindset. When resources like access to credit or the ability to insure assets become scarce, people's decision-making changes dramatically. They become more risk-averse, more focused on immediate survival and less likely to invest or plan for the long term. This psychological shift can amplify an economic downturn, turning a slowdown into a full-blown recession as fear and uncertainty paralyse economic activity. The Chancellor, Rachel Reeves, commenting on December 18, 2025, welcomed the rate cut, stating her expectation that it would help cut prices and that inflation would fall faster in 2026. She pointed to budget measures like freezing rail fares and prescription fees and a £150 average energy bill cut as ways to bring relief. I understand the political imperative to offer hope, but I also see a disconnect between these targeted measures and the systemic risks flagged by the Bank of England. While these measures offer some immediate relief, they don't address the underlying structural vulnerabilities in the financial system. It's like putting a bandage on a deep wound that requires surgery. The Bank of England is signalling that borrowing costs are likely to fall further in 2026, which sounds positive. However, they also cautioned that early signs of wage growth could pressure prices upward again, making a further rate cut in February 2026, for example, far from certain. This constant uncertainty is itself a corrosive force. You see, the bank's own analysis highlights that despite all these risks swirling around the finance sector, there is already no adequate access to finance for growth for the United Kingdom's small and medium-sized enterprises. These SMEs are the backbone of our economy, creating jobs and driving innovation. When they can't access capital, the entire economy stagnates. This isn't just a future threat, it's a current reality that will only worsen if the deeper financial instabilities manifest themselves. What I find particularly telling is the disconnect between the official narrative of gradual improvement and the stark warnings from within the institution responsible for financial stability. It's a bit like a startup that focuses all its marketing efforts on projected user growth while quietly struggling with a critical, unaddressed technical debt in its core infrastructure. The outward appearance is one of progress, but the internal assessment points to fundamental weaknesses that, if left unaddressed, could lead to a catastrophic system failure. The Bank of England's December 2025 report wasn't just a technical document, it was a profound historical echo. It reminded me of the lead-up to 2008, where the dangers were clear to some, but the political will or public understanding wasn't there to act decisively. The sheer scale of the shadow banking sector's expansion, unchecked by the kind of macroeconomic downturn that would truly test its resilience, creates a vulnerability that I find deeply concerning. Let me explain the fire sale mechanism in more detail, because this is where the theoretical risk becomes very real for you. If a hedge fund, for instance, makes a bad bet on gilts and faces massive losses, it might be forced to sell off other assets quickly to cover its positions. This sudden influx of assets onto the market can drive down their prices, leading to losses for other institutions holding similar assets. This creates a domino effect, where one failure triggers another and another until the entire market is under severe strain. When this happens, banks become extremely reluctant to lend, not just to each other, but also to businesses and households. They hoard cash, fearing unknown risks and potential defaults. This is the mechanism by which a crisis in the shadow banking sector could lead directly to reduced finance access for ordinary people. It's not necessarily a government decree freezing your accounts, but rather a practical inability to borrow, to get a mortgage, or for businesses to secure lines of credit. The Bank of England's warnings are not just about a future possibility, they are about current dynamics that are already in play. The fact that economists on the Shadow Monetary Policy Committee had already voted for the 3.75% rate before the actual cut, citing inflation undershoot, tells me that there was a broad consensus on the immediate need for stimulus. But the deeper, more complex warnings about systemic risk are, I feel, not being given the same public prominence. I want you to understand that this isn't about sensationalism, it's about recognising the inherent fragility of a financial system that has allowed a massive, unregulated sector to grow to such a size. The lessons of 2008, I believe, were not fully learned when it came to preventing the emergence of new, equally dangerous forms of systemic risk. And now, as we stand here in early 2026, those chickens are coming home to roost. So, what does all of this mean for you, for your family, and for your financial well-being, especially as we move deeper into 2026? I believe the cumulative effect of these warnings, the rate cuts, the persistent inflation, and the looming shadow banking risks points to a period of profound uncertainty for United Kingdom households. It's a situation where the promise of lower borrowing costs is overshadowed by the very real threat of reduced access to finance, which, in practical terms, can feel exactly like a freeze on your savings or your ability to utilise your assets. The potential for a systemic crisis spilling from the finance sector directly into households via stressed mortgages and rents is not a distant threat. It's a clear and present danger that the Bank of England has explicitly highlighted. Imagine being unable to refinance your mortgage or finding that the property you plan to sell is suddenly uninsurable, trapping you in a home you can no longer afford or no longer wish to live in. These are the kinds of tangible, life-altering consequences that I believe we must prepare for. What I find particularly disheartening is the burden that shifts onto individual households and the state when the financial system falters. After 2008, it was the taxpayer who ultimately shouldered the cost of the bailouts. If these new risks in shadow banking materialise, I believe we could see a similar scenario where public funds are once again deployed to shore up a system that failed to manage its own excesses. This cycle, to me, is unsustainable and deeply unfair. From my perspective, the current strategies of the Bank of England and the government, while aiming to stabilise the economy, might be underestimating the interconnectedness and the potential for rapid contagion from the shadow banking sector. The rate cuts are an attempt to inject liquidity and stimulate growth, but they do not directly address the structural weaknesses that the bank itself identified. It's a bit like trying to fix a leaky roof by painting the walls. It might make things look better for a moment, but the fundamental problem remains. You might be surprised to learn how quickly these economic shifts can impact your daily life. It's not just about interest rates on your mortgage, it's about the confidence of lenders, the availability of business loans that create jobs, and the overall stability of the markets where your pensions are invested. When that confidence erodes, the ripple effects are far-reaching, touching everything from the price of your groceries to the security of your employment. What I truly urge you to consider is the gravity of this situation. This isn't just another economic forecast, it's a warning from those at the very heart of our financial system about fundamental vulnerabilities. The year 2026 has just begun, and these are not historical events that have already passed. These are the challenges that are actively unfolding around us, with potential consequences that could reshape the financial landscape for years to come. I believe it's crucial for every United Kingdom citizen to be aware of these dynamics. While I cannot offer specific financial advice, I can impress upon you the importance of understanding the forces at play. Scrutinise your own financial situation, consider your vulnerabilities to potential lending freezes or increased costs, and stay informed about how these larger economic currents might affect your personal circumstances. The resolution to this looming challenge will not be simple, and there are no easy answers. It will require, I believe, a deeper reckoning with the regulatory gaps that have allowed shadow banking to grow unchecked, and a more robust strategy for protecting ordinary households from the fallout of financial instability. The stakes are incredibly high, not just for the economy, but for the financial security and peace of mind of millions across the country. I want you to leave this discussion with a clear understanding. The warning issued by the Bank of England in late 2025 about the risks in our financial system and the potential for reduced access to finance in 2026 is a serious one. It is a call to vigilance, a reminder that in the complex world of finance, What happens in the shadows can very quickly affect the light of your everyday life. Be prepared, be informed, and protect what you have worked so hard to build.